All right. Hey, everybody. My name's Brian Fine. I think I know a lot of you. There's some new faces for sure. I am JJ's business partner in Always Capital. We are a private lending institution. So we'll sort you guys out for financing for all your deals and everything else. I had a fancy PowerPoint, but then I'm in Pittsburgh and we had 80-mile-an-hour gusts of wind last night that knocked out power lines all over the city. So I just got power back like an hour ago and my laptop is not charged. So we're just going to talk tonight. But what we're going to cover is being bankable. So when we talk about lending, most of the time, from an investor point of view, you're looking at what does it take as an investor to get that lender to give you the cash. That's your primary concern. We're going to look at it tonight from the opposite end. What do you got to do to polish up your resume to look good to lenders? What makes you attractive to them? Because if you have never thought about this before, there is no shortage of people out there who want their money. But there is a finite amount of capital, especially when it comes to private lending. So only so much of it to go around. They're going to choose the best choice. So can somebody tell me what is the most important thing to a lender? What's the number one thing they care about more than anything else in the world? Anybody? Go ahead and unmute yourself and say.
Getting their money back.
Yeah.
You got it.
There it is.
Protect the principal. It is far more important to not lose than it is to win. So your interest rate is second place. They're doing these investments in order to get a return, but getting back the principal is even more important. So no matter how attractive you're offering as far as terms and points and all that, if they aren't confident that that principal is safe, they're not going to invest with you. That's not how that's going to happen. So there are three methods that lenders use to decide whether or not to give you a loan. And it depends on what kind of lender you're talking about. We call those no doc, low doc, and full doc. And if we cover full doc, you'll know most of it. And then we'll throw no doc in. That one's a little different. Full doc is what the banks do. So if you've bought your own house, you've gone through this at least once in your life. So it's not a very transparent process. You might not be aware of exactly what they were looking for. As an investor, you can totally go to banks, especially for your long-term buy and hold stuff. This is the cheapest money you're going to get, period. So if we can qualify for full doc underwriting, that's a good thing. It is an absolute pain in the ass. It takes longer and is more likely to have, the term they use is conditions, meaning they come back and ask a lot more questions. So they start with a lot of questions and then they ask more. So the first thing they're going to look at is a FICO score. And for better or worse, in the United States, the FICO score is a measurement of how well you do with debt. You guys may or may not know this. You know, there are multiple kinds of FICO scores. There's not just one. There are quite a few. The one that we use is specific to the mortgage industry. That is not the same as the one you're going to see when you pull up Credit Karma and see what you're doing. It tends to be a bit lower. If you would like to measure your FICO score and see what's going on, there is only one service that we would recommend. It's MyFICO. That one will give you all the different FICO scores and all three credit bureaus. Your freecreditreport.com and your Credit Karma only do two of the three. They don't do all three. They also don't give you the mortgage-specific calculation. MyFICO is not free. It's a couple dollars a month. But if you want to keep a good close eye on it, that's the tool you want to use to do it. For many of you, especially if you're rehabbing, you're going to do a lot with credit cards. Credit card usage has a direct and immediate impact on your credit score. Now, they changed the way it worked about a year and a half ago. So it's a bit simpler now than it used to be. No matter how many credit cards you have, they're all considered unsecured lines of credit. And they're all lumped together in one big number. And they divide it by 5. So you have 0 to 20%, 21 to 49, or 40, 41 to 60, so on and so forth. Each of those chunks represents a reduction. So if I'm under 20% usage, it does not normally have an effect on your credit score. You go to 21%, you take a hit. You go to 41%, you take another hit. 61, another hit, so on and so forth. For rehabbers, which I have done for quite some time, this is the biggest shift in our personal FICO score. I will max out my credit card for 3 or 4 months while I'm working on a project and then pay the thing off in one day when I sell my rehab, right? So you guys can see a fluctuation on that. When you're applying for full doc underwriting, you're going to want to time that so those cards are paid off. When they look at your FICO score, it's not just the number, it's also what's in the report. So when at Always Capital, when I look at your credit score, I'm not just looking at the score, I'm going to read every line on it. I'm going to look at all the credit lines you have. And one of the biggest things I'm looking for is consistent payment history. I want to see that the bills were paid with nothing late and nothing screwed up. If you didn't pay a debt, no matter how small, then that leads me to questions as to whether or not you'll pay me. And that's how they look at that. All right, so scores. Typically, to get a mortgage, what we're looking for is called a tri-merge, which means we look at all 3 of the credit bureaus: Experian, TransUnion, and whatever the hell the third one is. Equifax. That's it. Knew it was in there somewhere. And we take the middle score. So if you have a 600, a 700, and an 800, you have a 700. The middle score, whatever the middle number is. They usually don't have that big of a swing. But a lot of creditors will only report to 1 or 2 bureaus, not all 3. So you can be assured in mortgage underwriting, because of the dollar amounts involved, your lender is going to look at all 3. So even if you just had some random bill like a auto finance or something, only reporting to 1, we're going to see it. So if you have a higher credit score on the other 2, it's not going to matter. The low one's going to drag you down, and you're going to get the middle. Banks will do a hard pull. They do that out of habit. They're the slowest ones to change. Your institutional private lenders, pretty much all of us have switched to a soft pull. So we will no longer lower your credit score by checking your credit score. All right, but you can pretty much be sure your banks will. Generally, when a bank pulls credit, it's good for 30 or 60 days. When a private institution does it, we usually let it go for 90. Sometimes 6 months. It depends on how good you looked. So the FICO score is to your benefit, because we're using debt so much in this business to get that guy as high as possible. You're going to have a problem getting a loan below a 650. Anything below a 650, I suggest you take a look at getting a credit partner in your LLC. 650 does not mean you're going to get a loan you like. It just means it's not going to hurt you really bad or get denied over it. There are lenders who will do it at lower numbers, both banks and institutional private. It usually means a reduction in loan to value and higher interest rate. So that's it's in your benefit. Polish up those credit scores as good as possible. Keep them clean. Pay off any of those outstanding debts. The thing that hurts your credit score the most is unpaid, unsecured debt. So credit cards are nasty, but if you ever took out a personal loans are like cyanide for your credit score. Don't do that, and pay that off as fast as you can. Really bad. Mortgages are fine. Secured debt's okay, as long as it's current. So first major thing, that's your credit score. Before I move on, anybody have questions on the FICO stuff?
No, I have a question on the personal loans.
Mm-hmm.
You said they like cyanide for your credit?
If you have an unpaid, outstanding personal loan, completely unsecured, it lowers your credit score significantly just by having the account open.
Oh, okay, if it's unpaid. Okay, gotcha.
Oh, well, if it's unpaid, it gets a hell of a lot worse. Just having it is a big hit.
Oh, wow.
It's an unsecured debt. That's it. That's one kind that'll hurt you. Secured debt's fine. You can have cars, you can have houses, you can have boats. It doesn't matter, but there should be some kind of collateral against the account.
Okay. Thank you.
Sure.
My question is, what about a UCC? One of my businesses has a UCC from an idol.
You'd have to look at the report and see how the account's recorded, because I've seen those both ways. I've seen it not matter, and I've seen it matter. So it depends on how the specific lender recorded the thing or reported to your credit. Sorry, not super specific on that one.
That's all right. It's still SBA, but okay. Thank you.
Yeah, Yeah, again, it usually comes down to whether or not it's collateralized is the big deal. As long as there's but unsecured business loan, it's a maybe. Is the loan to the business and reporting directly to your credit, or is the loan to the business and not reporting to your credit? So, for example, when you borrow a rehab loan from us, we're going to check you as an individual, but the loan is to your LLC. We will not be reporting to your credit unless something happened to that loan. There's no reporting. So you'd have to check your report and see. Go for it.
So how does student loans affect your credit? Because right now I have some student loans that I'm currently paying off, but it seems like the interest is like all the way through the roof now, but I'm still paying on it. So how does that work?
So first, you got to go read and see what the amortization schedule is on them, because most of the time, what happens is the loans capitalized. And student loans are really interesting because you haven't had to pay on them in years.
Mm-hmm.
And in fact, I think the first enforced payment will be due like tomorrow.
It's coming up, I think, in a couple months.
Yeah, so it's been 5 years since anybody had to do that. And and honestly, I don't know how it's going to affect things, simply because there is a ton of laws about how they can report and hurt you. And 48% of those loans are in default. So I have no idea how the hell they expect to collect them. I have a student loan that I've never bothered paying off. I just make the payments on because it's an irrelevant amount. So I sort of track it. My loan has been sold like 5 times in the past couple of years. I barely even know who has it now. It's crazy. And that's somebody who kind of pays attention to this stuff. The average professional working student, I have no idea how they'll do it. So as for how we'd look at that as a mortgage lender, Full Doc would probably take a much harsher look at an unpaid student loan than we would. I'm not sure I would care as much as long as everything else is in good standing.
Okay, thank you.
So, but yeah, for Full Doc, it'll just be whether or not it's hitting your credit as delinquent or not. In most states, like in Pennsylvania, for example, they're basically useless. They're not allowed to report anything significant to your credit. They can't hurt you. Now, I will see it on the report. And if I see a whole bunch of charges for like $400 or $500 that have never been paid, then as a lender, I am going to ask, why haven't you paid these? And a bank may or may not. But as for damage to the credit score, at least in most states, I don't think they can hurt you that bad. They pretty much neutered them on the collections front, which is not. It's a good thing, I guess, in some ways, but it kind of sucks for the total cost of medical coverage in this country because they can't get paid.
If you're a Canadian citizen, how do you go about building up your credit history in order to get all the credit cards and other business loans?
Great question. I only sort of know this answer, so I will give a high level one, and then I would have to refer you to somebody who's a bit more of an expert in this. You can't really establish credit. You can get mortgages here. We have to treat those mortgages as non-recourse, which is the same as the kind of financing you would get if you were investing out of a retirement account. It means they can't consider you. So all they're going to care about is the property. Now that sounds really cool, but the terms are a little worse. Usually those are 50 to 60% financing. The easiest workaround for you, John, is going to be an equity partner. Take on somebody who's in the U.S. domestically already and has the FICO score, can just provide it, and then you're going to get way better terms across the board. There are ways to actually build a U.S. credit score. I am not super familiar with that, though. I don't really know how that works.
Okay, what is your use in LLC and for borrowing for mortgages? That shouldn't be a problem, right? You can build history that way, right?
Yeah, you can but that's moving towards a business line of credit with Dun & Bradstreet. That's its own. You can Google that. There's a process you can follow to do that. It's annoying, but you can totally go through it and get a business line of credit for your LLC and establish business credit.
Thanks.
Yep. In the end, though, again, an equity partner, or even somebody you just throw some cash to just to be a guarantor and give you a credit score is going to be a lot cheaper and easier than messing around with any of that. All right, cool. Any other questions on FICO?
Just medical bills.
Yeah, medical bills, so they will show up on the report. Whether or not the lender cares about it varies, and whether or not they hurt your score. In most of the states I'm familiar with, they don't. They're not allowed to hurt your score. Not really. So they'll show up on there. Now, you got to think of it, I think a bank would care a lot more than an institutional lender. I'm not sure I would care as much as a private lender on those things. If they're little ones, we're going to want you to pay them off. You know, you're about to borrow a couple $100,000 and you got $500 in medical bills. Why are we having this conversation? Pay them off, get them and go away. If it's $5,000 or $50,000 or something, that's a little different. That's going to go with the individual lender as to how much they care about that. Any other FICO questions?
I have a couple
Troy,
for you.
sure.
One, as just an example, say you're current on all your outstanding payments, but you have a couple months, say you're 1 or 2 days late, but you are current.
Mm-hmm. So what that'll do, if they reported them, because most of the time the reporting that usually happens is a 30-day late. So there's usually in most versions of credit reporting, it's 30, 60, 90 is how it shows up. So being a day or two late really wouldn't matter. They might be annoyed with you, but they usually won't report that. If you go past, they can hit late fees and things like that, but to actually hit your credit, it usually has to be more than 30 days. So
Right.
When you get one of those, they stay on your report for quite a while. There are two things we can do with it. One, it's a ding to the credit score, depending on how bad it was. As long as it was just a blip, you missed a month or 3 of payments, it hits you a little bit, but you can recover from it easy enough. As a lender, what we would do if we saw something like that is I would ask for what's called an LOX, which is a letter of explanation. You need to tell me why that happened and have a reasonable explanation as to why you fell off the wagon on that account. As long as we get an okay LOX, and expect banks to ask for those, as long as you give them a reasonable explanation as to why that happened, they'll probably be willing to move forward. But if the core score dropped too far, it's just going to be bad. And that brings me kind of to the other thing you guys can do, which is a credit repair service. What credit repair people do is they sue the 3 companies. They file lawsuits for you, at least the good ones. Crappy ones just send letters. The good ones actually file lawsuits in court. And what they do is they sue to have things removed. And so anything that isn't actively reporting to your credit can be kicked out. You can just get it taken off the report altogether. So I'll give you an example. If you had a closed account, a closed credit account, so you had a credit card, you had some kind of issue with it, you missed a couple of months of payments, and so now you have a more than 90-day late on that, and that's going to have a really negative effect on your score. That can drop you from the high 7s to the low 6s, just like that. It's a very, very hard hit. If you pay off and close that credit card, your score will go down a couple more points because you closed an account. Then you can get a credit repair person to remove that account altogether. And so now it's no longer taken into the calculation for your score, and the score can go way up. It takes a couple months for that to work. It's not an instant fix. So it's something you guys would want to plan for over the course of a year, not something that you can do when you already have a property under contract. We need to close too quickly, typically, to be able to do something like that.
Right. And I had one other question. It kind of works off the FICO score. What if you don't have a personal credit history? All you have is corporate credit.
If you have no established credit, you will probably need a credit partner. For a full doc, almost certainly.
Okay.
For a private, it's up to the individual lender.
Right.
So there's the old there's an old saying that low credit is better than no credit. I don't know that that's quite true. Maybe moderate credit is better than no credit.
Thank you.
Yep. one of the fastest ways to build credit, if you have somebody, whether it's yourself or a young person who doesn't have established credit history, one of the single fastest ways to build credit is to buy a car. Auto loan or auto lease is the fastest way to establish a credit history.
So my question is, how easy is it to remove a ding on your credit? I had, a late payment some time back. My credit is very good.
Mm-hmm.
Because of this, I was not able to qualify for a line of credit. Yet at the bank, I could qualify for a HELOC.
Yeah.
But I'm still uncomfortable about this situation because the other one would have been more beneficial for me. Is it possible to remove a ding?
Yeah, that's if the account is closed and no longer reporting, then you can get a credit repair person to do it. You could do it yourself, but it's not worth it. Just hire somebody and they'll take care of it. Yes, they can remove those. It's also a question of how much it hurts your score. So because if we're talking about as long as credit looks good, what is good credit?
750.
Okay.
But
you know what?
It was able to affect me from getting the line of
Yeah. From that particular bank, you can go somewhere else. Basically here's how I look at credit, and this is a little different than maybe you'll hear conventionally. An 800 score is useless. It means nothing. Actually, all it really means is you paid your bills, but you never really used debt. From a lender point of view, 650 is bare minimum. 680 is okay, but we don't love it. 700 is decent. 700 or higher, we consider you to have good credit. That's good enough for most of the terms you're going to get in real estate. 740 is really good, and 760 or higher is perfect. And so pretty much every institution out there is going to give you the very best white glove terms you can get from a credit score at 760 or higher. So having a 780, an 800, whatever, it doesn't matter. It just means use your credit more because you haven't done anything with it. But anything over 7 is fine, and anything over 740, I would consider that good. And so you can certainly shop around a couple of different institutions and find those kind of products. But be careful with just straight up lines of credit. That's that unsecured stuff I was just talking about. That really hurts your score. A HELOC is secured. There's plenty of reasons to use or not use it, but the HELOC versus just an unsecured line of credit, unsecured line is going to hit your score a lot harder. A lot of times they consider that exposure to be at 100% even if you haven't used it. So if they give you 100K, it's like having a 100K loan out and performing at all times. So just watch it. It depends on the particular product as to how they report.
Thank you.
Sure. So let's summarize real quick. For checking your score, My FICO, you can get it as an app. It's like 20 or 30 bucks a month. And you can turn it on or off as you need it. But if you leave it on, not only do you get real-time feedback on what your score is, you can lock your credit and make it so it can't be queried without your permission. So it can be some pretty good anti-fraud stuff too. So that's kind of cool. And it'll give you a very accurate look at what's going on. And it can also do simulations, like what happens if I pay off this much of the credit card next month? What's going to happen to my score? So it can give a fairly accurate guess as to what's going to happen there. For blemishes on your report that are on closed accounts, credit repair is the way to go. There are lots of good credit reporting agencies out there, or credit repair agencies out there. We can recommend one if you need them, but ultimately you're looking for one who will be filing lawsuits, not just sending letters. And then anything over 760 is perfect. And if your score is under really 700, but under 650, you're going to want a credit partner. Go find somebody who doesn't have that problem, because it's a lot easier to hire or partner with a credit score than it is to build one. So ultimately you want to get your own fixed, but if it's going to take you a year or 3 to do that, then it's a lot easier to just get somebody who already has a nice one and is very proud of it.
Hey, Brian.
Hey,
Hey, I got a question for you. Are you doing a lot of fix and flips?
Yeah.
Okay. All right. So I'm a full-time investor. All right. So I don't have a credit score. I'm an entrepreneur is not going to typically have a credit score, right? Because you didn't really talk about how you're purchasing these homes by utilizing the home itself, the actual asset, the home, instead of looking at our personal credit. I mean, that was the first thing you jumped on, and it threw me because I was wondering, well, why isn't he talking about the property itself
So
as
that's
the actual?
yeah. So we started with this is underwriting. This is how to decide whether or not to give you money. And what we began with is full doc underwriting, a bank, a full institution.
Okay, I'm sorry. I kind of thought you didn't get there yet.
Yep, didn't get there yet. Well, we're certainly the property obviously has to pencil and be good and all that. But a true loan where the only thing that is considered is that it is the property and nothing else is called non-recourse. And those are usually 50 to 60% loan to value. Nothing wrong with them. Just most of us want more leverage than that.
Right. Are you just talking about hard money lending on your side only, or are you doing PPL?
I'm gonna get to all of it. At the moment, we're on banks.
Okay, cool. Sorry about that. Go ahead. I'm driving.
You're all good, man. All good. So yeah, bank very much cares about your credit score. So do the institutional private lenders like me. And the reason being, we don't know you. You're a stranger. They have 100,000 people coming every day looking for their money. Like they all want to borrow it. And their number one concern, like we already said, is are they going to get their money back? The only thing they know about you, they can pull this report and see how you've paid your bills in the past. That score is nothing more than a representation of how well you deal with debt. And so when that score is high, you show that you have a good relationship with debt, you borrow money, you pay it back. When that score is low, that's a lot more iffy. All right, so that's why they consider it that way. All right, second thing they're going to look at is liquidity. And this one's a quagmire. How much cash do you have or could you get a hold of? And this is true for pretty much every type of lending you look at least if they know what they're doing. Reason being, things go wrong with these projects. Flipping a house and something comes up in the contracting, it's going to cost more money. The local municipality inspector gets switched over while you have your project, and the new guy decides to enforce a law that's been on the books for 20 years, but the other guy didn't enforce, and now you have about $8,000 in fines and fees you have to pay. This kind of stuff happens. Liquidity is a measure of how much cash you have on hand to deal with these unexpected things. What if the project takes longer and you have to make a couple of months more payments and holding costs? If you have no cash of your own, that's going to be an issue. So what cash they can use. So a lot of the fraud that happens in the mortgage industry is attached to liquidity. So they just changed the rules in January of this year, kind of across the board. In order to have somebody's money considered as liquidity, they have to be a guarantor on the loan. So if you have a money partner and the way you're going to make your down payment and closing costs and everything is to show their money and use it, then they have to guarantee the loan side by side with you in order for that to be considered. If you have enough of your own cash to show your down payment, holding costs, and all the stuff they want to see, they don't actually care what you use to close. So now you can use your money partners instead. They don't need to guarantee. So that's a big consideration for you guys. That's going to come up. Now, that rule has changed in the last couple of months. So whether or not the person guarantees is a big deal. Different lenders treat this different ways, but most of your banks are going to want to see 2 to 3 months of bank statements. For larger loans, especially with banks, they're going to want you to have your business account at their bank. Do not be surprised if they ask you to do that. So just walking into a bank you don't have an account at and saying, hey, give me a gigantic loan, don't be surprised if the requirements to even be considered is open an account with us and deposit some cash in there. The money that you have in an account at that bank, if you take a loan from them, they can seize it at any moment. It's in the loan docs. So just know that it's part of the deal. Obviously, they don't make a habit of this because it would give them a very bad reputation, but they can totally do it. So just know that that is a thing. It doesn't happen often, but it is a thing. So you need to be able to show liquidity. You should be planning on how you're going to do that. You should also, when you're looking at operating your business, how's your rainy day fund going to work? These investments all of them, whether you're flipping a house, doing a buy and hold project, ground up construction, owner financing, whatever, it doesn't matter. They carry risk. And if you do enough of them, something eventually is going to go wrong. You need to have the cash or access to the cash somewhere to fix those problems. And that's something that a full doc lender is absolutely going to look for. Do you have the money to fix a problem? If you have no money of your own, they're going to have a hard time lending to you, because how will you pay for any problems, much less pay them back? Any questions on the liquidity stuff?
Got a quick question. So I'm looking to acquire a 17 unit right now. So I'm glad that you actually touched base on the lender perspective. How do you guys approaching the percentage of like seller financing as far as, you know, seller carryback and the acquisition? I got the credit score and all of that great stuff, but I look for that lender side to see, because the seller's going to carry about 15% of the acquisition price. For maintenance of the property. And so how is your approach to that? And, you know, is it better from the multifamily side to go look at a private lender or so forth, or should I just kind of go look at the FHA side? Because they got favorable terms, but it's very, very long, arduous process.
Yes. Full doc is cheaper money, but getting to it is a lot more difficult and more likely to fail, quite frankly. Okay, seller carryback and any kind of owner financing. It depends on the lending institution, how they're going to do it. You're going to have a hard cap on the loan to value. They will not let it go above a certain number no matter what. And most of the lenders that allow this, it's not all of them, I'd say maybe a third will let you do this in the first place. They will take the first, the seller is allowed to hold a second, and you have to have a minimum of 10% down payment of your own capital. So usually 90% loan to cost is the typical way we see it. When you really get into it, most of the time it's not worth it. And the reason I say it's not worth it, this is more from the investor side. The number one point of failure in any transaction is the seller. What you're doing with a seller carryback is you're keeping your problems in-house. So now it doesn't end with closing. Now they can screw up your deal months from now, after you're far more invested in it. So just be cautious about it. Make sure the paperwork's good, and do the math on whether or not it's worth it. It can be a lot easier to find a money partner or use your own capital to fill in, because usually they can't carry that much to begin with because of the LTV cap. It just makes more sense to use your own cash. They can't get you to $0. No first position lender is going to let you. 90% is about as high as it's going to go.
Got it. Oh, okay. Is this specific?
And one more thing on this.
Sure.
When it comes to, especially with your banks and credit unions, if you do that, they're going to do significant sourcing on the funds you show. Meaning that money has got to be clean. It better have been sitting in that account for like 3 months plus. It's got to be really obvious trail as to where it came from. No question as to where this cash came from. You can't have borrowed it from somebody. They're going to look super, super close. They're going to look anyway, but if you're reducing your total equity in the deal to 10%, they're going to look really, really close. So just know that up front.
Got it. I just wanted to follow up right now. So if it's second position lien, now would they, because there's some other considerations I've thought about, I've heard some different ones. So I'm moving from single families right now to multi. It's just transferring. So in the situation, I've considered presenting which I have presented a deal where the seller would partner with me and have an equity stake in there for that seller finance perspective.
Yep.
And so essentially I'd own 70, or well, I would present as the owner 70% of the company that owns the property. He would own 30% of the company that owns the property. And then go to get a loan. Obviously, we would both have to be on the loan document. Correct, right?
You would.
And then would the reduction in LTV or reduction in the price, I guess, or so forth, because that 30% is going to be held. I mean, is it just
it actually gets a little sexier. That's the way you should do it.
Okay.
Because it's not a purchase anymore. It's a refi.
Ah, nice. Okay. I see.
Okay, so that's a little cooler.
Okay.
Now there's usually a minimum amount of time that has to have happened or whatever, but as long as they're guaranteeing the loan, you can usually get around that.
Okay. And do you know what that seasoning period is?
Depends on the lender. Somewhere between 0 days and a year.
Okay.
But as long as everybody is guaranteeing, you're probably okay.
Sounds good. Okay.
I can't say 100% on that because it does depend on the particular underwriter, but you're probably going to be okay. So that is definitely the way to do it. Again, the only thing I would warn you is that's a business partnership. That's like a little bit of a marriage here. So definitely play through, game out what happens if they lose their mind and suddenly want cashed out immediately and are going to be all pissy if they don't get it. So just play that scenario out before you get into bed on that.
Got it. All right. Well, appreciate it. Sure.
Sure thing.
I was going to ask the same thing. This credit sponsor, they got to stay for the whole term of the loan, right?
If they're a guarantor, yes. If they're not, yeah, I guess, I'm sorry. To use their credit score, they have to be a guarantor. So yes, they're on. Now, that doesn't mean they actually have to do anything, but in the event of a default, they're fully responsible.
Right. But I mean, for the entire term or until, I mean, you can change the financing or whatever you're going to do, but
yeah, they're in for the loan.
Yeah, it's a marriage then for sure. They could.
Yep.
This is where it can get really dicey, you know?
It can, it can, but there's plenty of folks out there who are comfortable doing it. I mean, pretty much all of you on this call probably know somebody who's super proud of their 850 credit score. That means they don't do anything with it. It's be like, hey, dude, I do a bunch of deals. I'm successful. Don't try to do it on your first one. It's not, that kind of pitch won't work on somebody that conservative. But once you've done a couple, hey man, I do a couple of deals. You want 10 grand to hang out with me in one of these deals? I need your credit score. It'll get me better terms. It'll save me 12 grand. I'll give you 10 of it.
Absolutely. Yep. I mean, even some high income earners that need some plays too. So it helps them as well. I mean, they're busy doing their high income earner occupation.
Yep.
So
100%. And you can, with them, they're really fun. You pay them in depreciation, which can be a very, very sexy thing to do. A little out of the scope of this particular call, but I think you guys have a good idea what I'm talking about.
All right, cool. Yeah, it's just getting them signed up for that could be a challenge sometimes too. They're like the whole life of the loan.
Yeah, but there's another way to look at it, especially when we're talking about equity partners. If you're not a guarantor and you're just this LP and something goes wrong with a loan, now you want to call me up as the lender and negotiate with me. I'm like, who the hell are you? But if you're a guarantor, you have full rights to negotiate with me as a borrower on this deal, and we can take steps to cure the default, prevent foreclosure, help you get through the project, preferably with everybody getting out profitably, right? But if you're not a guarantor, it depends on the lender. We'd still talk to you because we want to work with people, but it's going to be a lot easier if you're working with a bank or credit union. They don't care. The people making those decisions have no financial stake at all in what's happening. They just have the books to balance. They're allowed to have so many loans in default, and they don't care about adding one. Doesn't matter to them. If they make money or not, they could not care less.
At one point, I was going for this SBA loan, and I was looking for a partner like that. And the agent that I was working with was trying to let me know that I can get 60 grand and I can get it as a gift, as a true gift. Is that true? As when you was talking about the
okay, so that's more of a tax thing. You're allowed to receive a one-time gift of a certain amount. I thought it was 20,000, but there could be some exception to that. It's more of a tax question because people can give you get a gift of $1 million, right? But you have to pay taxes on it. Right.
So
Yeah,
so
the gift
receipt.
receipt. Yeah, the gift receipt is there's a amount you're allowed to do, and it's please don't quote me on this. This is from a couple of years ago, digging up my memory. I think you can do an annual gift of up to 10K and a one-time gift of like 20. If there is an exception to do something like a 60K, I'm not off the top of my head aware of it. That doesn't mean it doesn't exist.
Yeah, that's why I was asking. I wasn't for sure. I just knew that it came up in the conversation of me getting some money like that. So that was my question.
if you had a sudden deposit of like $20,000 and as an underwriter, I asked for a letter of explanation where the hell that money come from, and you provided me your gift receipt, which is the same thing you're going to provide the IRS. It's a tax document essentially. I'd be like, okay, cool, it's 20 grand a gift, and I would accept that.
All right, that was my only question. I just wasn't for sure. I just know I heard it through another person, so I just want to be for sure.
Yeah. You'd have to check the dollar amounts, but gifts are a thing.
Okay.
It does happen.
All right, thank you.
Hey, Brian, will you give a quick recap on the benefits of a personal guarantee money?
Yeah, sure. So if somebody is in an LLC at any equity number and they guarantee the loan, then their capital can be considered liquidity for the point of view of do you have enough for a down payment, holding cost, and showing what is needed for this loan. In the event of a problem or default, they're able to call and negotiate and cure it. They can take over. If you structure your LLCs the way that we teach you guys to do it, then in the event of a default, that minority partner takes over the LLC. They become the new owner. And then they can go ahead and fix everything, take over the project, and deal with that. If you're not a guarantor, it's not that doesn't work. It's just a little tougher. You'll also be notified. That's huge. So if you're a subordinate lender, so you're taking an equity position behind a senior debt lender like a bank or an Always Capital or something, if a payment is missed, we're going to notify the guarantors. If you're not a guarantor, I don't need to notify you. Hell, I don't even know who you are. How would I call you, right? If you're a guarantor, then you're going to immediately get a, hey, where's our payment message? And this would be true for banks and credit unions too. So now you'll be notified well within your 30-day window that something is wrong with your project, and you can take steps to cure that before it causes any harm. So it's a much deeper finger on the pulse. So it was kind of a mixed bag in previous years. Now I would say in general we should lean towards from a LP equity position point of view, you probably want to be a guarantor. It's a good idea, unless your credit score is really bad or something and you can't be a guarantor. Then you stay off for different reasons.
Very, very good. Thank you.
On liquidity, I heard you mention enough to cover the down payment and holding costs. Is there an additional percentage that's a minimum or a target that we're looking for?
Great question. Different lenders calculate liquidity differently. And then as an investor, you need to calculate your own liquidity, and it's a higher number than any lender is going to ask you for. So there's what you have to show them to get a loan, and there's what you better have so you don't get hurt. I'll give you a sample calculation. This is not universal. It's going to be unique to your lender. So whenever you're looking at a deal, you speak to your lender, you can find out the liquidity requirement. But generally, it's especially with private institutional money, it's pretty light. They want to see enough for the down payment and usually 3 to 6 months of loan payments. So it's pretty light. Not a lot going on there. Banks may ask for a little bit more. But if that is all you have, and I mean, it's really all you have, and it's a rehab, you're screwed. You don't have enough money to do the deal. So as a investor, you need to look at it differently. We have all the costs we have to pay. We have our holding costs. Every month I got PITI payment, or even if I don't have a monthly mortgage payment, if you negotiated that away, you're still going to have taxes and insurance. You got utility bills, you got permits. When we're doing rehabs, those are on reimbursement draws. You need enough cash to do some level of repair so you can get the draw and being reimbursed for it. We need something for that. We need cash for overages. We need cash in case things go past the amount of time we projected. Now, does that have to be cash sitting in a checking account? Not necessarily. Credit cards work just fine at Lowe's to get things done. But as an investor, you're going to need a higher number. Your lender, depending on the deal, is going to give you a more specific. For buy and hold stuff with no construction, it's a little easier. It's usually some amount of some months of payments is what they're looking for. With for my own buy and holds, the way we handle our internal requirements, it's 3 months of mortgage payment, and that's PITI. and 3 months of full rent. Those are two separate numbers. Added together, that is my liquidity requirement per unit. That buys me approximately 6 months, or really about 90 days if something goes wrong. That is the amount of liquidity I want. Now, it's fine if that's a credit card in most cases, but remember, you can't service debt with debt. So the 3 months of mortgage payments should probably be cash somewhere, at least able to be accessed.
I have a question. Does conventional lending also use 401k as liquidity?
Some of them do, but there's usually there's a rule with it that it's only 50%. So if I had 100K in a 401k, IRA, whatever, they would count it as 50 grand. You actually using that money to get the loan is a different story, though, because there's a bunch of rules about how your retirement is invested in now in something that's potentially a prohibited transaction. So it's a bit loaded. That one's a little more complicated, but most lenders will count a portion of the retirement as liquidity. All right, one more thing on the liquidity, guys, and I'll talk more about your private relationship lenders later. If you have a private lender, a friend, family, whoever, who is going to write you a check for 100% or more of the financing you need, you still need liquidity, because God help you if something goes wrong with your project. So you need oh shit money. It's really important. I have had friends get burned over this. Just because you didn't have to bring any money to closing, which is not actually a great idea, and it's for entirely different reasons. Just because you can do it doesn't mean you should, and you definitely need backup money. So eventually something's going to go wrong. So that's liquidity. So we have our FICO score, we have our liquidity. Third thing for full doc underwriting is 2 years of tax returns and a personal financial statement. Your full doc guys, your banks, your credit unions are concerned with what they call DTI, debt to income ratio. They want to know exactly how much money you're making year over year. They want to see that that number is stable or growing. And they want to see that if the project completely failed, as in your rental doesn't pay you anything, that you personally have enough cash to carry the mortgage for a time. That's what full doc people look for. So I don't have too much to say about that, except you have to have it. You need 2 years of tax returns that do not look awful. That doesn't mean you need millions of dollars, but you can't show $500,000 in losses 1 year and made 50K the next year and expect to get $1 million loan without a problem. That's not going to show them the stability that they want to see. Okay, personal financial statement. It's a good idea for you guys to have a PFS anyway and fill one out about quarterly. It's a great way to keep score. How are you building your net worth? How's it looking? What are your assets? What are your liabilities? Most of your banking institutions will make you fill out one of their own. So if you already have one that you're using on your for yourself, you can copy and paste. It makes life a lot easier. So if you're really crazy like I am, you do it monthly, but quarterly is more than good enough for most cases. But you will need the personal financial statement and 2 years of tax returns. The occasional lender will ask for 3, but 2 is usually enough. If those are both personal tax returns and tax returns for the entity that is buying the property. A lot of times the entity is new. So if it doesn't have 2 years of history because it was just born for this transaction, they'll waive that. Any questions on tax returns or PFS?
Let's go back to your PFS. What is that? Is that a bank statement you're speaking of, or
personal financial statement? It's just you can go download a billion templates of them.
Oh, okay.
Just down one side, it has what are your assets, what are your liabilities, what are your bills, what's debt, what's cash on hand. You add all this stuff together, and hopefully it's a positive number at the bottom. That's your net worth. That's how much you total have.
Okay.
Period. Right. So you would you'll add like your personal residence on it and that kind of thing.
I want to ask an oddball question. What if you don't have those 2 years of tax returns?
Then you will not be able to do full doc underwriting, and you better get somebody who can.
Well, I'll say I'm kind of like the example. I don't have tax returns, and I still go to my bank and get loans.
Yep. Well, then that's a direct relationship, because like JP Morgan Chase wouldn't even talk to you without being able to provide them a tax return. So yeah, the normal answer is 2 years tax returns. Usually the idea is that since lying to the IRS is a crime, if they can see your tax returns, they have the closest thing to the truth of your financial status. This is kind of the attitude among that. And then the last really major thing for your full doc underwriting is experience. How many deals have you done? This is another thing that has changed in the last year because there has been a lot of fraud around this. There are many lenders out there, banks and institutional, who will give better terms if you're more experienced. It's extremely common. We do that at Always Capital. If you have more experience, you're a safer bet for us. We're more likely to give you better terms. But there has been a lot of fraud around this. People basically faking deals, we call them straw borrowers. You'll get somebody who's done 100 deals, take 1% of your LLC, use their experience, that kind of thing. That stuff doesn't really work anymore. So the experience has to come from a guarantor. It cannot come from just a member of the LLC. So they must guarantee the loan. The experience has to be like kind and like place. Meaning, if you are a rehabber and have done 100 rehabs in Pennsylvania and you want to do a rehab in North Carolina, you have zero experience. It doesn't translate. Same thing goes for your rentals. They have to be in the same area as well. If I own a 18-unit multifamily in Pittsburgh and want to buy one about an hour away in with a different property manager, that experience probably won't count either. So they're very, very picky about experience now because across the real estate investing industry, that created a couple $2 billion in fraud last year. So need to be very careful about it. For you guys to record your stuff, it's usually HUDs. So purchase and closing HUDs is the most typical way that you will show your experience. The number you're looking for is 3 or more. That usually gets you the best, and that has to be within 3 years. Zero experience is okay. It just doesn't get you the greatest terms in the world from your full doc people. Okay, so if you can do all those things, show a good FICO score, have enough liquidity, show 2 years of good tax returns and a personal financial statement that's appropriate for the loan size you're looking for. And you don't actually have to show experience, but you can, if you can show experience, you do, then you can survive full doc underwriting and you can get your capital from a bank or credit union. For those of you doing long-term buy and hold, bank credit union money is our cheapest money. It's a really good life choice in a lot of cases. So as long as you can survive full doc underwriting, that's a nice thing. Okay. All right, then we have low doc. Low doc is easy. For low doc, we need the same kind of stuff that you need for full doc, except you knock off the tax returns and PFS, and there's no concern for debt to income ratio. Doesn't exist. What gets added in, and full doc people do this too, is we're concerned about the asset. Asset has to make sense. So for rehabs, this is really straightforward. There is an appraisal on the property as part of the underwriting. It gives 2 values. The first is the as-is value, which needs to be hopefully equal to what you're buying it for, or less, or more. The appraisal has to be equal to or greater than what you're buying it for. You also provide your scope of work. They will take that into account in the appraisal to give us an after repair value. Your loan will be based on those numbers. Up until that point, they'll take whatever you stated. I'm going to buy it for 100 grand. I'm going to put in 50 grand. I'm going to sell it for 300,000. Pretty much every lender is going to be like, sounds great. But then whatever the appraisal comes back at are going to be the numbers they actually use. So that part's easy. With rentals, it's a little different. It's DSCR, debt service coverage ratio. You guys can Google how to look that up. It's a bit out of scope for this call to go into it. But essentially, you're still going to have an appraisal, and it's worth the lesser of that DSCR or a percentage of that appraised value. When we're buying things that are buying them new, that don't need construction for buy and hold purposes, you guys can get, most of you will be able to get 80% on a purchase. I don't necessarily recommend it. If I put on my investor hat, 70 to 75% leverage is about where you want to be in new buy and hold stuff. If you go to 80% and something goes wrong, you'll need reserves to gap the difference because you don't have enough cash flow there. That's pretty much it on how they look at the assets. You guys have all had some degree of underwriting training. I could go into a lot more of it. I'm going to keep it kind of light for today. Okay, the last one. So that's everything you need to borrow off a private institution. So you know how to borrow off a bank. That's the super hard one. You know how to borrow off a private institution. That's always capital. The last one is what we call your relationship lenders. You're completely private people who just stroke you a check because they love you. This is the most finite money you have, and the underwriting is done by you as an individual. They lend to you because they know, like, and trust you. And you have to take responsibility for this. So how many of you, give me a, let's do this. I'm putting gallery view here for myself. Turn your cameras on. I can see all your pretty faces. All right, show of hands. How many of you know a private lender who's been burned and lost money? This is a catastrophic problem. We're in a very small swimming pool and we don't like people pissing in it. When you borrow private money, when you take from relationships, you have to pay it back. There are very few ways to completely fail at this business. Burning a relationship lender is one of them. It's a really bad one. You are done. I ever find out you didn't pay somebody back, don't even call me. It is okay for a deal to go bad. You got to make it right after the fact. And if it takes you a year or two, you got to find their cash and you got to pay back every penny of it. Does that make sense to everybody? When you borrow off of an institution, you borrow off a bank, you borrow off of Always Capital, guys, we underwrote the project. If it goes to shit, we're going to hurt you in the way that the docs say we can hurt you. That's meant to discourage you from doing this. But whose fault is it? It's not yours, right? You gave it to me to underwrite, and I apparently screwed up. I didn't account for the risk correctly. You borrow grandma's money out of her retirement, and you lose it on a bad rehab. Whose fault is that? And this is the Spider-Man thing, right? Great power, great responsibility. Do not touch this money unless you are ready to pay back every dime of it, no matter what. Okay, so that's a really big deal. All right, so let's talk a little more about your relationship capital. I am probably one of the only people you will talk to who has borrowed so much of this stuff, I'm sick of it. I have about $3 million in this at any given time. I do about $1 million or so a quarter in private capital. That's both fix and flip money, and we also do plenty of equity positions on buy and holds. This money is what I would call unstable. It's unstable because you can call up a relationship partner who says, hey, yeah, I want to invest with you on this deal. They say, yes, they're in. And then the day before closing, you call them up and say, all right, man, time to wire stuff over. And they're like, I think I'm going to take the kids to Tahiti instead. There is exactly nothing you can do about this. You're screwed. You now have 24 hours. You get to push your own closing, or you're going to fail to close altogether. This can damage your reputation. And there's absolutely nothing you can do about it because you can't exactly make somebody wire you tens of thousands of dollars. It doesn't work that way. So it is up to them. And until the money is wired over and the docs are signed, you don't have it. There is no such thing as a lock-in. There is no such thing as a loan commitment. Doesn't exist. Even if they wrote something that said those words, you wouldn't be able to enforce it because it's on a relationship. You may make your private loan for, you can write this down. Don't do one for less than a year. Write it down. The minimum term is 12 months. You want to screw up and piss off a relationship lender? Tell them you'll pay them back in 90 days and take 6 months to do it. Go ahead. Tell me how that works out for you. So 12 months should be the lowest one you're going to do. Even if you know you're going to pay it back sooner, the document better say 12 months. Don't do one lower than that. But if I do a 12-month loan and they call me up in 6 months saying they really, really need that money back, guess what happens? Or you're sure as hell going to try to find somebody to take their position. You're going to do what you can. If you borrow off Always Capital, what do you think the chances are of me calling you up and asking for my money back? It ain't going to happen. And if it did, you can and should laugh at me, because we're bound by the terms of the note. It's not a relationship-based agreement. Okay, this is the kind of stuff, have any of you ever heard this on private money? Have you ever thought of it this way? This is a really big deal. Everybody wants to focus on the, oh, I can get my 100% financing. Yeah, it comes with a price. And that price is that it's on your relationship. And you have to protect that. You have to do good underwriting. Because that money is so finite, I recommend that you always use an institutional first. It's a good idea. If I make your rehab loan and your private relationship money handles your gap, then the deal has been underwritten by a professional and the exposure is very low. It's a lot easier. It doesn't guarantee that nothing will go wrong. There's no such thing as a sure thing in this business. It doesn't exist. But it's going to limit that exposure. Also, here, you guys, I'll give you guys a couple of fun stats. Shake your head up and down if you know who Grant Cardone is. Is that a name you know? Everybody know Uncle Grant? Cool. Okay. Uncle Grant runs a couple of billion-dollar syndications. You guys know about these? He's got a Reg A fund and a couple others. They're publicly traded. Everybody knows these things exist. So you can go look it up if you don't know what I'm talking about. I have spent extensive time with some of his capital raisers. I know these people quite well. They're a lot of fun. And a really fun question to ask somebody who raises $1 billion in syndicated money is, how do you raise your money? Their answer to that question is $100,000 at a time, same as you. The average relationship lender has 100 grand. Yes, you occasionally find a whale, and there's plenty of people who have less than that. But your straight up average across the United States of people who will invest in one of your real estate deals is they got 100K. Raise your hand if you're operating in a market where the purchase plus rehab of your project can be done for 100 Gs. It's not very common. Median home price in the United States is $440,000. You need more money than the average lender has. And it's not like it's a temporary issue. They flat out don't have enough cash to do this. And as housing affordability continues to erode, it's likely that gap will increase, not decrease. So the best way to use that capital is in a minority position, in equity. I think I talked in my last call with JJ extensively about that. There's minority positions and limited positions in equity. That's the way to do it. It's much sexier. And use your institutional firsts. So that's the biggest thing on that money. Limit their exposure. Use a first position from somebody else. Put them in place with equity to protect their cash. You definitely want to protect their position. Generally, for most of your projects, just straight interest rate. This doesn't count if they're getting an equity split of the profit or something. Straight interest rate, that money runs 10 to 12%. It's kind of where it goes. Can be a little higher. It probably can't be much lower. If you're doing buy and holds, that means that you really need them to be a cash flow partner long term. You do not necessarily have the capital to be paying a double-digit interest rate, and that's what it needs to be in most cases. Because just like me, your private lenders do not have a shortage of people who want their money. And even if they don't know anybody else, it's your uncle, your friend. Once they do a deal or two with you, and they come to a networking event or something, or just start Googling around a little bit, and they find out there's 60 other guys out there with 10 times the experience that you pay and 3 times as much, what do you think the chances are that money jumps ship, right? So we want to have high retention on our capital, which means we're going to pay double-digit reliably.
Have you heard of anything like 40% on the returns for like a EMD?
Okay, so yeah, let's talk about the EMD thing for a second. That is unsecured lending. It's completely unsecured. It's extremely high risk. About 1/5 of all contracts fall out. So you have a 20% failure rate on straight average. If that contract goes hard, that money evaporated. And if you think about the kind of borrower who needs this, typically your EMD is 1% of the purchase price. So you're looking at a 1 to 2 grand on an average. Commercial stuff obviously gets bigger, and that's a different story, and you can negotiate a smaller amount. But you can only recover that capital until the inspection contingency ends. After that, the contract goes hard, and that money has evaporated. Whether they close or not, it's not coming back. For taking that kind of risk, yeah, I want one hell of a reward. And I wouldn't be looking at 40%. I would probably be looking at more like 100, because I'm going to take a 20% total loss. And so if you do quick math on that, just take $1,000 and run it through that, give yourself a 20% failure rate on those. Then I need a really significant return on that capital to even make it worth it. Another thing to keep in mind, it's what is the status of the borrower? This comes down to liquidity. They can't afford to put $1,000 in on their own deal. What are they going to do if something goes wrong? Right? They can't afford to put $20,000, $30,000 down on a multifamily they're about to do. What are they going to do if something goes wrong? It's not like the scale alters here. So do they have the capital to cure it? And if you have the $1,000 to cure it, why do you need to borrow it and pay somebody 100% return on it? It's crazy. So the EMD thing as a business model, I would take serious look at your bank account and before doing something that is borderline gambling. Just keep that one in mind. Keep that in mind. There are wholesalers out there who can build a business that is scalable enough and secure enough to control those risks. They can't eliminate them, but they can control them. And because of the scale of what they're doing, they do need to have some kind of line of credit or something with you or with somebody to do that. But again, I'd be very careful about it. It's a very high risk lend.
Okay, cool. Thanks for that answer there. What about maybe a $5,000 non-refundable earnest money deposit?
It's the same thing. It just goes hard instantly.
Okay.
It's gone. The thing is, from our point of view, so as a lender, I would never do it because it's unsecured. I have no security. Even by what you just said, right? Non-refundable. Yeah. Okay, I put this money out. I cannot get it back. What is it collateralized against? Does the
property?
I don't own the property. They're buying it.
Well,
and if
can you put a note on it? You know, like a
nope.
They don't own it yet. Something on it?
Nope, okay. They don't own it. And if the seller doesn't sell, it has nothing to do with them that you failed to perform, or they failed to perform. So no, you can't. You could cross collateralize to something else, which may make sense in a larger deal. So if it's a big project, like they're going to buy a multi-million-dollar multi or something, and they need that cash. Okay, cool. Give me a lien against another rental you have or something, and I'll give you $30,000. But then I'd rather do it as a cash out refi and just give you the 30 grand, and you can stop talking to me about what you're doing with it. So it's just a risk reward thing. If it goes wrong, you have to assume 100% loss because there is no security. Now, if they make it right, if it's a relationship thing, they should pay you anyway. They should make it right, but you're going to lack the capacity to enforce that beyond a personal guarantee.
So yeah, so my question is kind of like, with the recent change into like wholesaling and everything, and I know you're touching a lot of the bases of what's new and what's upcoming. So as a lender, you come up with a lot of people that coming at you with double closes, and I have done a double close before, but though thank God it went through pretty much okay. But I have heard people telling me like some of my lenders that I kind of deal with and kind of network with and talk with, that they don't do double closes because of the risk factor and everything. And this here was like on just like with 100 doors. What's your opinion upon that? Do you advise against it, or do you say that we should do it or not?
So there's as a structure, double close is totally cool. There's nothing wrong with it. You do need a good, solid title company. And actually, here, all of you write this down. There's only one title company worth having. It's BCHH Title. They close all 50 states. So you can use any title company you want as long as it's them. They are owned by Stewart. Anybody know who Stewart Title is? If you've bought any properties and read your docs, you do. Stewart Title writes the title insurance policies. They literally do damn near every transaction in the country. So you are using Stewart Title whether you use their title company or not. So BCHH Title is a fantastic life choice. They do all 50 states. There are not a lot of title companies that can do that, and they do it very well. So when you're doing structures like that, I would use a solid title attorney to get it done. I know we like BCHH for that. Makes us happy. And then the other thing is the rules with double close are fairly simple. You got your AB contract and your BC. None of the money from the AB none of the money from the BC can be used to fund the BC AB. So you need what's called transactional lending. From a lender standpoint, this is the greatest loan known to man. If I could get it consistent enough, it would be all I did. It's perfect. I love it. My money is out for 24 hours and it comes right back to me.
Right.
It is super easy to underwrite because we have in the BC transaction, that buyer is getting financing or a commitment or whatever. We don't wire our transactional money until we see the cash from the BC in there. So my money literally just takes a quick ride through the wire and comes right back to me 1 to 2 points higher. That's all it does. So it's super easy, super clean. It does cost a little more from the point of view of the investor wholesaler. It used to be you did it to hide how much you were making from the seller. It doesn't necessarily work that way in a lot of states anymore. But there are quite a few states, Pennsylvania included as of January 1st, where unless you're a licensed real estate agent, you need to double close. It's just going to be a requirement. So as a structure, it's becoming more common because they're forcing it through law. So that is making transactional lending a little easier. Good news, world's easiest loan to get. So yeah, that's cool.
With that being said, does that deal count as a deal on your on your deal reference deal sheet?
Yeah. Yes, it does. It doesn't count as two though, even though you have two HUDs.
One.
it's still
and you
just
can
one.
stack them up quick like that.
Yeah, that's right. That's right. Now here's the thing, and this is going back to the experience. It's like deals. So if you're the buyer, if you're the BC buyer, then sure, it absolutely counts for you. If you're the wholesaler, all it means is you have experience wholesaling, and what the hell good is that? It's not rehabbing, it's not buy and hold, it's not ground up. It's none of the things we would actually need financing for. You don't really need any experience. The only underwriting for transactional funding is the AB and BC contract. That's really all you need. And usually I'll want to see the title commitment and the mortgage commitment from the BC side, and we wait until title verifies they have the capital from the BC before we fund. So it's again, world's easiest loan. There's essentially zero risk. I just send my money out, check the box, and get it sent back within a day or so.
Awesome.
Love doing them.
I thought I was going to get a deal experience off of it too.
You could try. I mean, if you have a really dumb underwriter, they might count it that way.
All right, cool.
Mm-hmm. It's a big deal, especially within our community. I really hate seeing or hearing any stories about somebody's like, oh yeah, I lent my private money to somebody and it blew up and now they owe me hundreds and hundreds of thousands of dollars and they aren't returning my calls. Please never do that. That is your exit from this business. And if you guys are considering private lending, don't let these horror stories screw you up. Use a institutional lender like me in first position and take the equity position behind. You're going to limit your exposure. You can charge more, and the deal is going to be underwritten correctly. All right, Belle, if there's no other questions, I think that'll end my ranting on this topic for the evening. All right, guys. So I hope you enjoyed our little talk here on how to make lenders love you. You want to polish up those FICO scores, have a nice PFS and clean tax returns if you're going to go through full doc underwriting. And when it comes to your relationships, if you borrow money, make sure you are ready to pay it back in full with interest, whether the deal goes south or not. As long as you're able to do that and able to convince others that you will do that, you shouldn't have a problem getting the necessary funding for your deals. Thanks, and we'll see you on the next call.